All right, what's going on, everybody? Happy Friday. Hope y'all had a good week. I mean, it was a short week. We got to do what we do, but it wasn't that bad. Wednesday's stream uh, didn't record, so I had to take a moment to make sure it was doing its thing this time. Everything seems to be working. Audio's fine, I believe. I don't want to sound like that Verizon commercial. Can you hear me now? What about now? Let me just check the audio real quick on YouTube, make sure that it's doing what it's supposed to do. Yep, I can hear it. It's good. All right. So, y'all got anything you want to specifically hit on? Because we do got topics today. Always, right? We always have a topic. But if anybody had something they wanted to touch on, we could do that. The topic today, it's kind of a multi-directional topic, is a continuation from Wednesday. We got to talk a little bit about market conditions and then tradable opportunities in within this current market backdrop. We really want to try to find some lower risk, higher reward trades and try to eliminate those trades that have outsized risk. Um, that can be a little tricky, and everybody's taste for risk is different. I don't want to make it sound like there's only one way to do this because man, there is not. And you should not gauge your risk compared to somebody else's. I'm a very risk averse person, which is, I don't know, maybe a little funny considering how much trading I do, but it's my level of risk, right? It's what I'm comfortable with. And so a lot of stuff that I see people trade, I just shake my head and I think, man, not with my money. I wouldn't trade that. And yet they trade it and they like it and they don't have any problem with it. Right. And that's the main thing is make sure the trades that you're taking are the size that you're okay with. Because I promise if it's not, if it's too big, you'll make all the bad decisions. You're not going to want to. It just inevitably works out that way that you will end up making bad decisions because the trade is too big. So, how big is too big? Well, unfortunately, only you can answer that. I've seen these books over the years that mention how much of your account you should trade with and how you should, not use, quote, too much of your account in a trade, but you could certainly size up to X amount of your account. I never did like those books because I've noticed it encouraged people to trade with size because they'd say, yeah, in the textbooks, it says that we could use, I don't know, pick a number, 8% of my entire account on a trade. Now, if you got a $200 account, you're not going to have much chance to trade. But imagine you're trading with a big account, right? Half a million or $1 million, and you're feeling like you're obligated to put 8% of that $500,000 into a trade because, well, that's what the book said. That's a recipe for disaster. So we don't want to feel obligated to meet some qualifications for how big we should trade. And I always get nervous when someone says, how big should I go in this? The fact that you're asking says you shouldn't go big at all because there's something missing in your trade logic. And that means that it's a risky trade just because you don't have all the knowledge of the parts and pieces that belong in the trade. So you should probably dial it back and trade it small. Tom Sosnoff from Tasty Trades has a little phrase: trade small, trade often. This gets overlooked by options traders a lot, but if you're a probability based trader in the options world, that's what a lot of traders do is they run the probabilities. Then it's all about occurrences, right? So if you're doing credit spreads, out of the money credit spreads, premium trading, income trading, that sort of stuff, those are all probability based trades. And if you're attempting to do those, then the probabilities or the percentages matter. One trade, one time, it doesn't matter how high the probability of success is. Well, that one trade can lose, right? So you could put on a 95% win rate trade and that damn thing could lose after all, right? Because one trade, one time doesn't have statistics, it doesn't have probabilities. It has coin toss odds 50-50. Maybe it works. Yeah, maybe it doesn't. If he was to trade that same trade 500 times, then you would start to see that 95% probability show up, which means you would still lose 5% of those trades. So, what Tom Sosnoff at Tasty Trades, what he always talked about was just keep the size small and then just trade a lot of them. And he didn't mean a lot of lots, right? Like you don't build one trade and then take a 30 lot on that one trade. What he meant was go out there and scatter those trades all over the place. Put one on SPY and the Qs and I don't know, Apple and Microsoft. Just scatter them around all over the place and keep them small so that no one of those is going to be big enough to hurt you. And if your probabilities are in the right zone and you've got even just a little bit of edge, then your probabilities are going to play out, right? So that kind of trading always works. It doesn't matter if it's election year, if the Fed is providing forward guidance or not, if we're going to get rate hikes or if Japan intervenes, and none of that stuff matters because it's all probability based trading, which makes it kind of cool. Unfortunately, there are some caveats, caviar. There's some problems. So some of the problems is um, we tend to lean one side, right? I think we all do that. I know I've got that problem as much as anybody else. So if we're in a bullish backdrop, most of my trades end up being bullish, and if we're in a bearish backdrop, then most of my trades end up being bearish. That's all well and good unless it flips on us, right? If we've got 25 trades on scattered between Microsoft and Apple and Amazon and the Qs and the SPY, and they're all long and the market flips, well, get every damn one of them is going to lose. Every one of them because they were all the same trade. Apple is SPY. Microsoft is SPY. SPX is the Qs. They're all the same damn thing. So if one loses, they're all going to lose. And that means you've got concentrated risk. And that's where a lot of trouble comes in with the whole idea of trade small, trade often. You have to really diversify the products that you're trading. That way, if you trade oil and Bitcoin and gold and then SPY or Apple or AMD or whatever, now you've got some diversification. You can also try really hard to spread it out between longs and shorts. That's harder than it sounds because when every damn thing out there is going up, how are you supposed to find a short? Or if everything is falling, why would you trust a long? Right? But trying to find some way to diversify the trades that you're in helps to make sure that when the market does flip on us, you don't end up with a pocket full of losses. And it does add up, right? So when I started trading, I started with a very small account. I just didn't have any money, right? I started with $300 and I had to make it work. And that was all the money I was gonna get. So, I really had to make it work. Well, I grew that 300 out, and I didn't do it with futures because back then we didn't have the micro futures. We only had the minis, and you couldn't trade a mini with a $300 back then. So, you know, I didn't have much choice. I went into options, and I tried to focus on things that had 50-cent wide strikes. This, for an example, XLF is one of the things that I traded frequently. XLF is a smaller product. It has 50-cent wide strikes. It's also boring as hell with no volatility. So when you sell things in here, you don't really get much money. It's just the way it goes, like you're not going to make a mortgage payment on a product that has 50-cent wide strikes and has options that are trading for less than a dollar. It's just, you're not, but you're not going to lose big either, right? So when you go to build an options probability trade, you get to choose what your probability is. What sort of win rate would you like to have? It sounds great, like you're just stepping up to the counter at McDonald's. Hi, welcome to McDonald's. What kind of win rate would you like in your trade today? It sounds funny, doesn't it? But it's for real. What would you like to win? You want a 80% win rate trade or a, 65? 95? What do you want? Sounds almost too good to be true, but it's not. It's the way options play. And if you've never heard this before, then you're really just getting into the options trading world, and there's a lot left to learn. A lot left to learn. But it's worth it. Now, some brokers have this probability based system built into their platform. And then others, you just have to use the old school tactics and kind of see it through the old system. I'll show you both today because I've got more than one broker. So this is Tasty Trade, and Tasty Trade has this system built into it so that when you go to build a probability based trade, it'll tell you what your chances of success are in that trade, which is really awesome if you think about it. That way, if I want to have a very consistent trade strategy, say that I want to do credit spreads with a 65% chance of winning, then I can make sure that every single credit spread that I build has that 65% probability. That's pretty awesome, right? Now you might be wondering, why in the hell would I want 65 if I could have 95? I mean, it's a fair question. When I was new, I was thinking the same thing. Why not get more? If it's my choice, wouldn't I want the higher win rate? Who the heck wants to lose 35% of the time? But everything has consequences, and the market is very fair and very balanced. So here is SPY. I'm looking at February 20 just because it's the next monthly out. No particular reason other than that. And if I build a trade at the money, we can see it's $1 wide and they're offering me more than it's worth. This is a $1 trade at the money. It's worth 50 cents because it's $1 wide. It's half the width of the spread as its fair value. Why are they offering me so much money? It's almost like they're asking me to take it. You know you want it. Come on, put a cap on SPY. Sell us those options. We'll buy them from you. We'll pay you more than they're worth. The fact that they're offering me more money than they're worth is a red flag. They don't screw up, right? It's not like you found some edge in there that the market makers don't know about. You see this much imbalance on a trade and they're giving you a gift horse. Well, they say don't look a gift horse in the mouth because it's probably got bad teeth, but you should because this has bad teeth. You don't want this. It's too good to be true. But what if I took it anyways? So what, right? So what? What's my chances of this trade? First, my max loss is only 33 cents. So I'm risking $32 for a chance to make $68. Okay. I mean, I like that risk to reward right there, right? That's 2 to 1. This trade has a 50% chance of making 50% profit, not a 50% chance of making some money at all somewhere along the line, or even, making something at expiration. This says I have a 50% chance of making 50% profit in this trade before it expires. Not bad. I think we could bump that up by choosing different strikes, but still, that's a coin toss, 50-50. So that's not bad. What could we do that would be better? It'd be maybe finding different strikes or a different expiration, going farther out of the money, something like that. But what if I just want the old school number? What if you don't have Tasty and you still want this trade and you want your probabilities for this trade? Well, you could just use the old school number, use the delta. That's what we used to use back in the day before we had all these fancy tools. I have two strikes, so just split the difference between those. I have a 52 and I have a 50. Split the difference, we'd say it's a 51, right? I'm not much for, the one there, so it's a 50% chance, which, heads up if you didn't know, an at the money trade is always a 50% chance trade. Right? So this trade has a 50% chance. Now this broker is telling me right here that my pop, it's what we call it, probability of profit, my pop is 49. 49, 50, 51. I mean, come on. We don't need to split hairs here. It's 50%. So you can see your pop on any broker at all as long as you can see your delta. That's all you need is the delta column. So if we were to go to Thinkorswim and bring up the delta column, there's our delta. We can see that delta, right? So the Monte Carlo system that Tasty is running here with this P50 number, that's unique to them. They're the only broker that I know that has this Monte Carlo system built into it. It cost them a lot of money to even figure the system out, and then it cost them even more money to build that system into their platform. And they did that because, well, they are options traders too, and they knew how valuable this tool was for us as traders. So they made the extra effort. I really appreciate it. If you're looking for a good options broker, this is a good options broker. That's not the only reason, but it sure is nice, to have that. So, knowing that we can develop a trade with a consistent break even means that we can go out and we can build an entire trading system around this logic. But the more information we have, the better the system would work. Just because I build a trade that has a 65% chance of winning doesn't mean that everything is golden. We still need some rules about how much credit do I need for this trade, right? Because what if it's a 65% chance of winning trade and my risk is like risk one to make 25 cents or risk four to make one? Well, that would really suck, right? I'm risking way too much money. I'm not getting enough profit, and winning 65% of the time won't cover my losses. The 35% of the time that I lose will wipe out all my gains plus some, and I'd be in the hole by the end of the year. So that won't work. How much money do we actually need if we're going to be winning 65% of the time to make up for the losses that we will get, the 35%? There's spreadsheets that are out there. I've made some myself along the way over the years. I went digging for one the other day and I couldn't find it. I think it's because I just don't keep them, right? I end up throwing them out along the way. Oh my goodness, that's bright. Screw you. Ah. So I thought, well, we could talk about building those today, right? And I don't know if I get a chance over the weekend, maybe I can build a new one. We don't want to spend today actually building it live. At least I don't think you guys want to do that. You'd probably get bored out of your mind doing something like that. Can't we just put some background on here with color? I don't really need a picture. I think so. Format cells. Yes, please. Phil. I never met Phil, but yeah, we'll do Phil. Hey, that's better. You know you like it. I like it. Ta-da! Now, how bright is it when we uncheck everything? Nah, it's still a little bright, but not bad, right? That's not bad. A little more, just because we're sensitive. That's better, right? Okay, so there's some simple logic behind this. Keep it at a dollar. Let's format these cells again. Um, two decimal places. We'll leave all that alone. We don't need to get funny with the scripts, borders, fill. The numbers should be good. Yeah, there we go. That's good enough, right? I like it. Make it a little bigger so you guys aren't squinting at the screen. Yeah, no, I can't talk and type at the same time. I know I can't chew bubble gum and walk. My bad. Yeah, your audio is fine. All right, so what do I got here? $1 wide trade, collect 65 cents. That means we have 35 cents on the loss, and it means that our win rate or our pop or probabilities is 65. If we were to trade this strategy 100 times, 1,000 times, we would win 65% of the time. That sounds pretty good. Is it enough? Do we have enough credit here for this to become a viable trade? Or when we lose, would the losses wipe out our profits? And what about the strategy that people use where they close the trade at 50% profit? And I'm sure you guys have heard that before, right? It's really common on the sell side of strategies. Sell to open, at like a 10 delta, hell, hold it till you get 40 or 50% profit and then close the trade down. That's really, really common. So that means we're not actually going to get 65 cents in credit. It means we'd get half of that. So 32 cents. So now we're risking 35 for a chance to make 32. Well, that kind of simplifies the math because that's almost a 1-for-1. We have to win 50% of the time just to break even if we're trading a 1-for-1. Well, that sucks, doesn't it? So with this system, we would have to get all of that credit all of the time, never close the trade early, and then run the numbers and see if it is a viable strategy and if it would work. So with that in mind, would it work? I suck at Excel. I keep wanting to take these advanced Excel classes, and then I never get around to taking the the Excel classes. I'll just run normal Excel. I'm just saying I can get done what I want done, but I'm certainly not fast at it. That lady that does Excel, she teaches it. She's so fast. It's like she just thinks of it and it's just flowing on the screen. It's so beautiful. We don't want this to be a percentage, a dollar value. Oh yeah, we do. All right. So if we were trading a $1 wide credit spread and we were collecting 65 cents in that trade, then we have a 65% chance of winning. And that's because it's just simple math with the pop. If we adjust all of these numbers, what happens if we start using something like delta instead of my credit? And why would we do that? Well, because what if we're using a $2.50 wide or a $5 wide trade? $1 is easy because I can just use the credit collected as my probability of profit. But we can't do that with wider trades or even narrower ones. This could have been a 50-cent wide trade, right? So instead of using my credit for the pop, if I used my delta, then it would shift everything. Are we getting enough money for the trade that we're going to take with the probability of profit that is built into that trade? So rather than me just using some fictitious numbers, we'll just grab some numbers here. This will make it $1 wide. These are 50-cent strikes. So from 53 to 54, that's 51 cents. And if we split the mid on this, the delta would, we could just use that 46. We have a 46% chance of this trade working out. Or if we wanted to use the P50, the P50 is 64. We got a 64% chance of making 50% profit in this trade or a 56% pop. I'm surprised that number says 56 because even our short delta is at 53, but I'm not going to argue with him. Let's use that 56. So we got 52 cents in credit in a $1 wide trade. And that means we're risking 48 to make 52 if we hold it all the way to expiration. But our pop was 56. So if our chances of winning is 56% and we traded this 1,000 times, that should have been D3. $2,912 is what we would make if we held it all the way to expiration and we didn't close it early. What about the 48% of the time that we lose? Right? So you can do the same thing. Only as a losing outcome. Does that look right? Now, what did I do on that one? We'll just keep it easy. Let's get rid of all of this. We're not even going to do any rounding, right? We'll just use the dollar math. $520 if we did that trade, and $480 in loss if we did that trade. If we traded it 1,000 times, that's the outcome. Just to keep things simple, right? That would be our outcome. Now you can make a spreadsheet like this, and then you can put the numbers in. This number here on the end isn't even needed. I just put it there to show how wide we were building it. And you can make your own little cheat list. Is this enough money? Sure, if we close at expiration and hold it all the way and don't close early. Otherwise, if we start closing these early, then it's going to mess with things. Now you can argue, well, hey, Sig, I'm never going to hold a max loss trade. I will get out in advance. Okay, so put your loss number in there. You can put whatever number you want because you can just manually trade it, calculate it, right? So what's your manual loss number on a $1 wide trade? Would that be half the width? Then, okay, $240. On the profit side, what if you did aim for half the profit? It's $260. Is it enough? 50-50 on each side. You'll close the trade at half a loss. You'll close the trade at half a win. It's still good enough. Why is the numbers working out so awesome? It's because I built it at the money. So now that we can see how it works and it's all nice and easy, what if we don't build it at the money? Because, we want to go out of the money and feel safe and put a little distance between us and trouble. Now you can build these systems with whatever probability of winning that you want, right? This trade has a 19 delta, so it's got a 19% chance of winning. Let's build it on Tasty. It's a 55-56. Tasty says it's got a 78% chance. Yeah, I should have flipped my delta over. It's got a 78% chance of winning at expiration, so that's pop, and an 87% chance of seeing 50% profit by expiration. Well, that's not bad. So we have a 22% chance that we'll lose. And the loss is pretty bad, right? The loss is $87. The max profit is $13. So in this situation, what did I do here? Is this going to be enough? If we win that trade 1,000 times, we'd make $130. If we lose that trade 1,000 times, and actually, we need to adjust some numbers here. Out of 1,000 trades, if we won 56% of the time, that's 560 times that we won, which means 480% of the time or 440% of the time we'd be losing. Now let's run these numbers. So we're going to win 78% of the time. That's 780 trades. And we're going to lose 220 times out of 1,000. Look at that. Even if we hold it all the way to expiration and we got max profit for it, this trade strategy, traded 1,000 times with the pop that we have, is not enough money. Now you can argue, yeah, but Sig, I'm not going to hold the max loss. Okay, you're going to cut that $13 in half too. So you're going to hold the winners all the way to expiration, but you'll close your losers at 50% profit. It's possible, but unlikely. But okay, we can cut the 191 in half. That would be what, $95 a piece or something like that. I think it's even a little more than that. 95.7. So if you closed at 50% profit on the losers, you would still be at 95.7. And your winners, if you did manage to hold them all the way to expiration, would be at 101. So you trade it the whole year, you put 1,000 trades on, and at the end of it all, where are you at? You're barely above break even. And that's if everything went perfectly and you closed those losers at 50% and you got most of those winners as a winner. Why did I even go through all of this, right? Through this whole thing? It's because the probability based trading can line you up with your outcomes and show you what's a good strategy or not. We haven't even looked at a chart, right? We're building things just here in the options chain, poking around at different strikes. If we were on support or resistance, if this was a stock that had made outsized moves and we had some expectation of a reversal, if we had any edge at all in the trade that could grant us a little favor, then it would be better, right? Because the options can't see that. That's edge for us. But without anything at all, just running the probabilities, we can still stack the trade with edge on our side. I mean, look at that win loss up here. I like those numbers. They're not fantastic, but I like those. I don't like these. All right. So, mechanical trade systems, any system that you want when it comes to these mechanical probabilistic trades, you don't want your probability of profit to be too high. 78 is what I used here. And as you can see, it sucks, right? If your pop gets too high, you have to make sure you're getting enough credit or the system won't work. Getting a high pop and a high credit is like the unicorn of mythical trading. And it's what Tasty Trades excels at. They have all these videos that talk about make sure you trade a high IV product because those options will have a lot of juice in them and they'll have so much credit that it makes it worth the risk, right? So that it beats these odds. If we built the trade with a 78 pop and this thing was offering us 27 or 30 cents in credit, like, double what we have now, all of these numbers would be different. It'd be way more awesome, right? Without it, things are horrible. So let's say that we do make 25 instead of 13, and that makes this 75. Well, things look a lot better already, right? And then we split that 165 in half again. And you're looking at $82 if we close at 50% profit. So if you held to max expiration, you can make about $195 if you traded this 1,000 times. And if you were closing at 50% loss, then you're going to lose about $82 at the end of the year. After you took care of your winners, that strategy would make you $112.50 if you traded it 1,000 times. Not bad for a 78 pop trade, right? Not bad. So Tasty's approach says make sure you're getting enough volatility in the trade. It's rare to find that kind of volatility. You can do it, right? There's all kinds of IV rank scanners and that sort of stuff. The problem is that volatility is a word for movement, right? So when something has a high implied volatility, it means it has a high chance of making big moves. That's exactly what you don't want it to do when you're in a spread that says, "Hey, I bet you don't move," right? Because that's what a credit spread is saying is, man, I hope you don't go anywhere. If you don't go anywhere, I'm going to make some really good money. So just sit tight and don't move. But the high IV says, hold my beer and watch this. I bet I can move. They've got some numbers. Anything above 50 in the IV rank is considered good. So you could run a rank scanner and see what has high IV. Be careful because things that have earnings also have a high IV, not necessarily a high IV rank, but a high implied vol. And that can mess with rank a little bit. And so you can end up with a lot of earnings names showing up in your scanner. But high IV things generally have a very violent, volatile chart. And that makes it kind of scary if you want to go in and put on a trade, right? but this is the system that's out there and it's really popular. Trade like an 18 to 22 delta, and try to get 1/3 the width in credit. And I've got them all written down if you want the tasty trade approach. The thing is, I tried to find it for a long time, right? Like I tried for a long time to find high rank stuff or high IV stuff. And I was having no luck whatsoever. None. The stuff that it would find me would be earnings, or it would have really bad options and just horrible stuff that I didn't want to trade. So it got to the point where I was like, okay, maybe they found the mythical magical formula to put on out of the money options with the proper amount of credit. But if you can never find the trade, then it doesn't matter that they figured out the formula, because it's an unattainable trade. You just can't find. How are you going to trade small trade often if you can never find one? So there had to be another way, right? There's got to be a better way. My way eliminates some of that problem, because instead of having to find something that has a high IV, you can trade anything, even something like XLF. It doesn't matter if it has a lot of IV or not. Because remember, we need the IV to give us credit, and the credit that it's giving us is going to help pay for those losses, because we know there will be losses. Okay, we'll just accept it. There will be losses. That's fine. I own the t shirt to that. Build it near the money or even at the money if you want. Doesn't matter. I like to go in, but on the money, in the money, near the money. Just don't go way out of the money. That controls your probability, which we can put pop on if we want to. Here's our probability of being out of the money, which means being a winner. If I sell the 53.5, which is this one, then that's the one I want to focus on. This has a 56% chance of closing out of the money at expiration. I really like splitting the difference between these two numbers. It's generally what I do. But if you want to just, be hardcore, just use the one you're selling as the probability factor. If you split the mid, it's 65. So this has a 65% chance of closing out of the money. Works for me, right? So with that much credit and a 65% chance of winning, I'm going to win 650 out of 1,000 trades. I'm going to lose 350 out of 1,000 trades. Will that be enough credit for that trade? And you can run the spreadsheet to get the answers and look at the outcome. Now you can build the entire strategy this way, because it isn't about one trade one time. It's, do I want a strategy that does this? That way, when you've got the strategy built and you're flipping through the charts, which is how I like to find trades, I don't use scanners to bring me, quote, tradable opportunities, because I have found that to be completely worthless. But I do like to manually go through my charts. When I come across something that looks like a good trade, either a long or a short, with a probability based scenario, I already know how I want to build the trade. So here's VOD. It had this big gap up, and now it's breaking out into 52-week highs. Heck, for all I know, it's all-time highs, right? It might actually be all-time highs. Doesn't matter if it is, it's not. I didn't think it was, but it could have been. It's breaking out into 52-week highs at the bare minimum, and it looks like a great long, right? I'd short that turd. I mean, you could go long if you want to, but I'm looking at it and I'm thinking that looks like a nice short. I'd sell a call credit spread on that. Well, where am I going to put the trade? Just like the strategy that I developed, I'm going to put it where it fits. I already know what kind of delta I need or what kind of pop I'm looking for. 65 pop's not bad. I don't mind that at all. And let's do that then. So if I sell a 46 and I buy a 76, then split the difference. It's probably more like a 56. 40 to 70, 50, it's 60. Yeah, that's close enough. 60. And look at that, 37 cents in credit. This strategy will lose, right? We know it'll lose 35% of the time, but it'll also win 65% of the time. I know how much credit I need to aim for, 50%, right? If that's what we're doing, then you make all of these rules in advance. So then when it comes time to take the trade, you're not sitting here for 30 minutes screwing around in the option chain trying to figure out, well, what strike do I want? Is this a good strike? Maybe that strike. What about this strike? What about that expiration? No, this expiration might be better. I don't know. You don't want to be in that situation, right? Jump in, get your trade, move on, get the next trade. If you already have the system, then you already know what you're looking for. That way, if you come in and you don't see your system, you're done. You don't have to sit there and keep looking at this stuff because you don't have a trade. You move on. What I trade, what I just saw here, what I was pointing out, hell no, this thing's an illiquid turd. We don't want this trade, right? I was just using it for an example. Look at it. There's no trades here. You're going to be the one making book. I don't want to be an options dealer. I want to be an options trader. So I don't want this trade. You don't want this trade. Now, there is no wrong way to do this, right? But there's some common ways out there. When it comes to the probabilities and all of that. If you want to go long instead of short, you can do the same trade near the money, at the money, and you already know that you're building a 50% win rate trade, just as if you was buying stock, because buying stock is a 50-50 trade, right? It's a coin toss. Maybe you win, maybe you don't. That's a stock buy. Well, if you trade it at the money, it's a 50-50 chance. And you already know how much the trade could lose because you're paying that debit. Now, how much of that you're willing to lose versus how much of it is left to make a profit, that's on you. This is $2.50 wide. My max profit is $1.25. My max loss is $1.25. All I have to do is close this at less than what I would normally close as a winner, and I can skew the risk to reward in my favor. It's 50-50. So set the stop at 75 cents and set the profit target at $1. There's my skew, right? All of this comes into play as a discussion of probability based trading because if you look at the market right now, there's really not a lot of good setups, but stocks that are moving around like crazy. Well, how are we supposed to find high conviction stuff? If you can't trust the Fed and you got no forward guidance and you got the president with volatility bombs every weekend and they're trying to fire the Fed chair and the government's about to shut down. You got QRA next week. uh, You can't trust the trades right now. You can't trust that the technical analysis is going to hold from week to week. But a probability based trade is still going to win with that probability. I think that's my basket of penny stocks. Looks like a big basket, so I bet that is. Yeah, that's my penny basket. I've shared that watch list with you guys before, right? This we went through and marked out all of the penny increment option traded products that have weekly options. That way, every name in this list, you at least know that it has penny priced options and it has weekly options. So it's more likely to be liquid than some of the other stuff you could find out there. One of the reasons I like probability based trading is because you don't have to know a lot of technical analysis. Any technical analysis that you know is a benefit, right? Because it'll help. You know a tiny little bit, fine. Use whatever little bit you have, and that's better than nothing. These trades don't require that you have any technical analysis whatsoever. So if you have even a fingernail of it, then you're good. You're better than better than the one who doesn't. This gives you a chance to trade while you learn and learn your as you grow and let your account grow while you grow. So if you have a list like this and you're trading in a small account, just get rid of every big name that's in there, right? Or use some restraint and just don't trade the big names. You can put butterflies on them and things like that, but we're talking risk trades. So then you just start flipping through the charts and you're looking for a tradable opportunity. I do like extremes and I do like breakouts and breakdowns, mainly just so I can go the other direction, right? But it doesn't matter. It's a probability based trade. So if you do trade a breakdown and you're wrong, as long as your probabilities are running, then the trade isn't going to be any worse for wear. That kind of looks like a Busby on Apple. And I am partial to Apple right now because they're going to fix Siri this year. And that means they're getting ready to spend a boatload of money. And rather than getting punished, I think the market's going to reward them for it. So long above 250 is what I think when it comes to Apple. We're not above 250, but who says we need to wait? We have a gap that needs filled, and we are really close to earnings. So there's some concern there. Earnings is next week on FOMC week, no less. But I like it. If we were to put a long trade on here, we could just build a probability based trade near the money, at the money, on the money, and let the probabilities do its job. We don't even need to apply any analysis at all. If the theory though is to trade small and trade often, and it needs to be small enough that you look at the risk and you say, yeah, I don't care. So before we look at Apple, let's go back to XLF for a minute. This trade risks 78 cents. I don't want to lose 78 cents, and that's max loss. And we don't have to even eat the whole loss. We can close that at 50% of max loss. So you're talking what, 37 cents, 38 cents? Are you going to stay awake at night sweating over the fact that you're risking $40 here? Probably not. I won't. I don't want to lose. Pretty sure you don't want to lose, but I'm not going to worry about $40, right? That trade is so small that once I put it on, I probably wouldn't even look back at it. Might set an alert, maybe not. Whatever, right? I wouldn't sweat it. So that's how you know if the trade is small enough. So now we can come back and we can talk about Apple now. This trade is $2.50 wide. It's risking uh $1.30 for a chance to make $1.20. Even if you cut that in half, call it what, $65 ish, right? 65, 62, something like that. Are you going to stay awake at night over $62? I mean, maybe, right? One time, maybe not, probably. Build it small enough that you just don't have to stress on it. The smaller the better, because you want 50 of these. You want 100 of these. You want as many of these as you can get. The problem is you got to diversify them so that you have some that are long, some that are short, some are in commodities, some are in yields, some, spread them out. If they're all on the Mag 7 and the Qs and the SPY and they're all the same direction, you're going to lose everything, all of it. They're all going to lose. So don't do that. Try to diversify, which is why I like to beta away the account and I just take whatever beta I need. So this is a good approach because it allows you to trade without the stress of finding setups and trade triggers and all that stuff, right? It throws the whole thing in the trash and instead allows you to focus on the probability of the trade. I'm looking for something. Just a second. Yeah, it's really bad that you showed up late because it took me 40 minutes to get to where we're at now, and there's no way I can sum that up in two, right? But I checked and I do have, yeah, I have the replay. I'm staring at the replay right now just to make sure the damn thing is working because I screwed up Wednesday and you guys didn't get a replay, and that's on me. You'll definitely get a replay today. I'm looking for something right now. I haven't looked at it for a while, and that's why I'm hunting. But I've got my strategies for these kind of probability based systems written out. And by no means do you have to have what I'm about to show you if I can find the damn thing. But it really does help, to have something. They don't have to be like mine, just to have something, right? I think I found it. I'm getting there. No, that wasn't it. Just a second. Watch him be in my trade book. When they said that you could open 100 discords at some point, I must have just decided I was going to take them up on that offer because my goodness, I've got a lot of discords. All right, this is how I started putting it together. I created a name for the strategy because if you want to trade a consistent options trade, then you need to have some criteria that you can refer back to again and again and again, kind of help keep them consistent, right? So, one of the things that helps with that is to give it a name. It doesn't matter what you call it. I call mine the public credit. Honestly, I don't remember why I gave it that name, but it doesn't matter anyways, right? This is my at the money logic for neutral probability trading, turning each trade into a 50-50 shot. Because I like 50-50 shots. They're great. Then your edge takes care of the rest. Um, if you want something in the 60s, then just move a little out of the money. And like I showed you guys with the Delta, and then you can get 60 instead of 50. Some of my rules that I go through as a checklist is no earnings within a 30-day window of the option that I'm going to trade. Take Apple. It's got earnings next week. That doesn't mean we can't trade Apple. It just means we can't choose options that will land anywhere in that 30-day window, 30 days before earnings or 30 days after earnings, right? Because this is a big deal. I've had a lot of people say, I don't understand how you're supposed to trade stock if it's got earnings and then you got FOMC and then you got CPI and PPI. You got all these risks every month, every week. We got risk. How are we supposed to get into any trade? Well, you can still trade. You just got to pick your poison and know what you're going to avoid. For me, I want to avoid the earnings. That's on the 19th. So no trade within 30 days of the 19th going that way, and no trades within 30 days of the 19th going this way. I think we can get there. Almost there. Oh, it was there. It's close enough, right? We'll just say that that was 30 days. So I wouldn't get any options in that span of time. Looking at that, that means I need the March options expiry or better. So like this 20 MAR, that would work. So my rules are pointing me towards options and telling me what options not to trade. No options within a 30-day window of earnings. No options within a 30-day dividend window, right? I can't trade stocks that have parabolic moves. Not for the at the money credit spread. I got strategies to trade those. Just this one isn't designed for that. No stocks that have massive gaps. I get it. Um, some people see size differently. I caught a fish and it was this big, I promise. What do I mean by massive gaps? This is emerging markets. It's a really good example of what gaps look like. This thing has a lot of China stocks in it. So it moves significantly in the after hours. And that means it's got these big gaps all over the place, just big gaps. Now, gaps on earnings is okay, right? Every company out there that we would want to trade probably has a big gap on earnings. Don't let that shake you loose. That's just a big earnings gap. But when it's got day after day after day of unexplained, unavoidable, absolutely no reason gaps just every single day, I don't want to trade that. So I don't trade that. Right. This is the kind of stuff I don't want to trade. Big gappy sucker every day with another gap and another gap and another gap and another gap. So that's what I mean by no massive gaps. And avoid companies that are less than $10. Now these are just my no rules, right? It's what it says right there. That's the no rules. I wouldn't mind trading something that's less than $10, like Ford, right? Ford was like $6 for a while. You know what I mean? Ford's a good company to trade. The problem is if you're trading earnings and it's too cheap, that you don't have a lot of strikes, you don't have a lot of directional opportunity. You're really handicapped. If it's too cheap, it's too cheap. So for me, less than $10 with this strategy, I don't want to do it. I'll choose a different strategy. Now I do like edge. So I like support type trades. And that can be resistance too, right? You could just, instead of thinking about something that came down and is at support, you could think of something that had run up and is at resistance, because it's the same trade. You just flip it over, right? So I'm a little lazy. I didn't write out market at resistance because in my mind, I was just thinking, well, it's the same thing, flip it over. So what is support? I mean, anything could be support: fib lines, moving averages, pivot points, floor pivots, yeah, all kinds of stuff is support. So uh, define your support. That way, you know, if you use Bollingers and you want to use a Bollinger, then use a Bollinger or Keltner channel or whatever. It doesn't matter. But don't guess later. Make sure you wrote it down. This is what I'm looking for. Is it moving, resting on a moving average? Is it resting on a price pivot, a fib line, a trend line? I would let any of those be a validation of support or resistance. What about breakout trades? I mean, I like breakout trades. Breaking out of what? Breaking out of yesterday's high, 52-week high, a monthly high, last week's high. So you got to define, what is it breaking out of? Moving average crossovers are nice. Price pivots, fib lines, angular trend lines, which I'm not a fan of, but whatever, put it on there. I mainly put that on there for like falling wedges and rising wedges. That's usually about the only kind of angled trend line that I really use, but whatever. And then gapped. Now, gap is tricky because you got breakaway gaps, exhaustion gaps, gap and goes. You know what I mean? There's so many kinds of gaps, but there's gap trades. So for me, on market gapped, look at yesterday. Was yesterday a red day and it found support? Was yesterday a red day and it's closed near the low of the day? Was it gapping from within an IX10 pattern, or did it gap above the previous day's open or the previous day's high? So, define your rules. And then the what if. The what if is kind of important. I see a lot of traders who are actually surprised when they get a winning trade. They're like, shoot, this thing's up like 15%. What do you think I should do with it? Should I hold it or keep it, or what am I doing? And I always smile a little bit because at least they're winning, but it's scary, right? Because you don't know, should I close this winner down or kind of hang on to the winner and try to get more out of it? You don't need to be in that situation. You should already have had the answer before you took the trade. So have an answer. What if? We're not going to focus on the loser, on the winner yet. We just want to focus on the loser. What if you're wrong and it falls through support or breaks through your resistance? Look at the next level of support or the next level of resistance. Are you willing to stay in the trade to make it to that next level? Because that's what it would take. If you're willing to roll the trade, that's what you're going to want to focus on. If you're not willing to roll the trade or manage the trade in any way, know that before you get in so you don't worry about it later. Like, oh man, it's losing. Should I roll this loser? Would it even do me any good? You don't want to make that decision later. Have it in advance. What if it breaks support? Where is the next level of support? And are you willing to stay in this trade for an additional 60 days or more for it to get to that support? Look again. Elevated volatility. If we are using volatility, we want to use the IB rank or implied volatility percentile above 40. I don't, but sometimes I help other traders out and they'll focus on volatility. So does this particular trade have elevated volatility? If it does, we want to consider that because we want to make sure we understand the credit that we're seeing. Alternate products. If the market you want has bad options, look at its peers. Find something in the same sector, the same industry, even the same sub industry. Find something that is an ETF of the thing that you want to trade and maybe trade it that way, right? Just because it has bad options and you don't want to trade that particular thing doesn't mean you don't have a trade. You could just trade its cousins or one of the ETFs. Then my rules. The days to expiration, if I am counter trend trading or short duration trades, then I'll use Friday with 11 days to expiration. Markets in confirmed uptrend, 30 to 45 days to expiration. And then markets in an uptrend but are under pressure, I'll use 65 to 90 days to expiration. This isn't where I have to go. It's just, hey, don't exceed this, right? So if it says 11 days to expiration, I can get underneath that. It could be 10 days, 9 days, but I don't want to really get above that. Need that to be the ceiling. For the 30 to 45, you guys, you know how it is. You go look at the options and then you just don't have an expiration at 30 to 45, right? Like sometimes you go in there and look and it's a 29 and a 53. You know what I mean? Like that's just all there is. Well, if that's all there is, then that is all there is. There's nothing you can do about it. Look at emerging markets. Not that we wanted to trade it, but look at the monthly. It's 56. And yet the other one is 28. Didn't I just mention that? It's just how it goes. So would I walk away because it's 56 instead of my 45? No, you have to play the hand you're dealt. I would not look at the 42s here. I mean, I would look at them, but I bet they're not liquid. And if they're not liquid, then I'm not going to trade them. So I won't pick this one just because it has the right days to expiration and break all my rules about liquidity to do it. I would rather either skip the trade and don't take it, which is not a good option, or go for the higher number. I want 45. I will take 56 if I have to, because I don't have a choice right here. Right. So the rules are not set in stone. You have to be willing to uh, be flexible with it when it comes to those days to expiration. Option strikes. We want near half the width of the trade. That's the goal, right? That's why I build them at the money the way that I do. But near 50% doesn't mean we're always going to get 50%. If it's a dollar wide, you might only get 48 cents. I mean, that sucks, but it happens. But on the other hand, if it's a dollar wide, you might get 52 cents. Hey, I'll take that too, you know? So you get a little good with the bad. And if it's SPY, look, you just don't get SPY at a good price. When I showed it earlier and it was offering us extra money, that was telling us don't do that, leave it alone. So if it's too good to be true, yeah, it's probably too good to be true. I think that was at this February strike when we found that earlier. I think it was. It still is. Yeah, look at that. That's really bad. So if it's that far out of whack, I don't see that and then go, woohoo, let's do it anyways. No. I just leave it the hell alone because there's a warning here that says this is mispriced in a bad way. It's not a good thing. So change your strikes, do something. Don't trade that. Wow, it's still mispriced. Serious. Okay, we had to go all the way out here. 697, 698. Wow. Well, you know what that means? It's very bullish. Yeah, that's crazy bullish. The market's pricing in a high probability that we go up and we get this gap up here plus some, right? They're actually aiming for like way up here, 695, 698. There's a lot of money up there right now. 695, February 20. That's a lot. Might do something with that a little later. All right, so you're looking for 50% of the width of the trade. All right, so if you're opening a one lot, don't go bigger than $3 wide. This is for me, not for anybody. Use your account size to help gauge how big of a trade you would want to take. For me, if it's a one lot trade, I can make it up to $3 wide on the strikes or less. So no $5 wide strike trades, no $10, that sort of stuff. If I'm doing a two lot trade, I need to keep the width of the strikes at $1.50 or less. And if I'm opening a three lot or more, then the trade needs to be $1 wide or less. For this particular strategy, at least back when I was building it, that was my restrictions so that I wouldn't build a trade too big, right? Just the size of the strikes took a lot of names off the list. Because if you go look at, say, Apple or Amazon, Google, Meta, Microsoft, you won't find $1 wide strikes, right? Well, okay, well, I guess I just don't get to trade those with this strategy. Then the rules about liquidity. It's got to have weekly options. I need a sizzle greater than 1.0. The bid ask has to be less than 7 pennies. And the open interest has to be 100 on multiple strikes in multiple series. 100 is really light, right? You wanted to tighten that up some, you could make that 1000 or 500 or something better than 100. And then the take profit model. If I'm fading out, I can take profit at 25% profit. Uh, take profit at 50% if risk still exists. That might be an odd way of saying it, but say you're in the trade, you're up to 50% profit, and next week is FOMC. Well, that's risk. We have risk, it still exists. Why don't I go ahead and take that risk off, close it out at 50% profit? And if I don't look ahead and see risk, I can hold the trade until it hits 80% profit. And then I really need to get that trade closed. So I want out at 80%. And then I have an example of one of those, right? Now, this is an SPX trade. It doesn't fit into the rules we were talking about. just showing a typical credit spread with some decent credit. In the SPX, you don't get half the width of the spread. It's very rare, anyways. And when you find it, you probably don't want it because you know it's imbalanced. So getting $4 on a $5 wide trade, that's pretty common. Actually, this was a $10 wide trade, $4 in credit. It's not half, but it's close. It's about as close as you get. And you can see the break even. I did the math, put my break even on the chart, showed what I needed price to get above and stay above for this trade to be profitable. So this was one trade strategy, an at the money put, or not even puts, just an at the money credit spread, what I call a public credit spread. You can do the same walkthrough for a butterfly strategy, iron condors, long verticals instead of short verticals. And you can build them for very specific kind of verticals. Like if you want to do a specific Mag 7 type trade, you can make an ETF vertical. So there's no wrong way to go. You just want to flesh out all the rules so that you know what you are allowed to do and what you're not allowed to do. You won't get it in one shot, I promise. But if you took the time to write something out like this and then you trade it a couple times, inevitably you're going to run into something that you didn't cover in your writing. Great. Call timeout there. Think about how you want to resolve the situation, put that into your rules. And from that point on, now you've got something else added to your rules, right? Over time, you'll build out a very excellent set of rules to trade that particular strategy. It's all probability based. So, you don't need to bring in things like Fibonacci's and moving averages and MACDs and all that sort of stuff. You don't need it. You could have it, certainly you could, but you don't need it. For something like a 0-day trade, I got the same thing, right? The whole idea when it comes to these kind of trades is that we can think about what we need for the criteria and the rules, and we can lay it all out, and the setup isn't based on, candles doing a certain thing, and instead just what our rules are. All right, low risk, high reward, or higher reward, right? Since we're in control of the trades that we put on, we define the risk for ourselves. There's a few products that you can't be assigned, like the SPX. It's cash secured. There are no shares, so they can never assign you that stock. There's also the XSP. This is exactly like the SPX. It's cash secured, no shares, can't be assigned, but it's the cost of SPY with all the rules of the SPX. This is a great product for doing things where you have risk of assignment, but because of its rules, you can never be assigned, which is awesome, right? That means if you end up with an option in the money, so what? It's cash secured. You're not going to get stock ever. And it won't early assign because it has the European rules, so they can't early assign you. That's really nice because now you can build an options trade completely in the money if you wanted to and have no risk of assignment. Let's suppose we think it's going to be bullish next week and we're going to go up. And I want to do a credit spread with a probability in my favor. This is like a Jeremy type trade. Only instead of a 0 day, it's a swing trade. SPY's got an expected move next week of $10. Well, let's just split the mid on that a little bit and say we make a $5 move next week from 92, well, from 91 to 86 or 87. Not quite a $5 move. We're building it in the money. This is risking 30 cents for a chance to make 70 cents. Now, we don't have any edge here yet. We're still running on probabilities. But if I filled that trade, I've got a 2-to-1 risk to reward easy, right? It's actually better than 2-to-1, but whatever, just easy numbers. 2-to-1 risk to reward. That means I only have to win 50% of the time, and I'm going to come out gold by the end of the year with just that strategy right there. I could trade one of those every day of the week. Probability wise, it's better than a 2-to-1, and I have a greater than 50% chance of winning. That strategy will work. And if I traded it every day for the entire year, I would make money. No technical analysis required. Just like that. So here's the XSP. 7 days out, so it's next Friday. I think I had a 7 and an 8. Yeah, I think that's what I had. This has uh, a P50 that's not even showing up and a really low pop. What's up with that? Maybe I'm breaking it. It doesn't like it. Or that other trade is still on that I was building. Maybe that's why. Huh, I'm not getting a P50. It could be that it's not liquid enough. And no, it's not liquidity because SPX isn't even getting one. Somebody broke Tasty Trade. Well, we already know the pop, right? This has a 40% chance of winning because it is in the money. I'd argue that it's better than 40%, but whatever. But we've got a 70 down here. There's the numbers. If we run it all the way to expiration and take max profit, we'd make 280 at the end of the year. And if we took a full loss, we'd be at minus 180 at the end of the year. And if we take those numbers against each other, we'd come out at about $100, right? 280 minus 180. So that's a profitable strategy right there. And anything that you could do to bump that 40% higher would just make these numbers better. You don't have to close early. You don't have to do anything. Just put them on and let them go. Every day, you could just throw it on and let it go and never look back. And because of that probability, you would win. Now imagine adding technical analysis to it to make it better so that you're not doing it blindly. You're doing it with some edge, something of some kind, and give you a little bit of reason to do it, make it better. I could argue that maybe your input would actually make it worse. Sounds bad when I say that, but look, I was talking to somebody last week and they said that they're losing every single trade that they put on. Every trade, it didn't matter what, every single trade. And I said, well, that's almost impossible. Look, you got to lose because we all got to lose. But on accident, you should have won like, once in a while, just on accident. You should win like, oh, damn, shoot, ouch, I stubbed my toe and I want to trade. If you're losing every single trade, it's you. It's not your strategy. So, this strategy with no technical analysis or input from you whatsoever, if you traded it every single day, you'd be profitable at the end of the year. If you get to trying to pick and choose and you start losing every damn trade, it's not the strategy, it's you. So if you can add edge to the trade and make it better, awesome, do that. But if your input screws the numbers up and you start losing more than, the 60% that you're supposed to lose, then it's you. There are some mechanical trades that you can do to add to this too. This would be mechanical. You could put one on every day of the week. Um, let's say I don't want to do PDT. So we want to put one on and we're going to keep the 7 days to expiration. That way we avoid the PDT as well. We're going to put one on every day that is 7 days from expiration because, it's SPY. So there's one for every day of the week. We can always put one on 7 days to expiration. And we could make sure that we target a delta of 60, call it 60s, because they'll move around on you and you can't just make it something as specific as 65, but you could say my short leg needs to be in the 60s, preferably, mid 60s or lower. You could say it something like that. You could also be specific about how much credit you need. Like, don't collect less than 65 cents in credit. If it's less than 65, you got to adjust your delta strikes. But don't go for the high probability stuff, right? The high probability stuff would be way out here. That has a 80% chance of winning. That has a 95% chance of winning. See that 5 cents in credit? When I mentioned earlier that you could have a high win rate trade, there you go. If you want it, you put that on, you will win 95% of the time. I promise. Trade it 1,000 times, you'll win 995 of them. The problem is you'll lose so much money along the way that you'll give up, right? Because one of these that is a loser, Oh boy, it hurts. So you don't want something with a high probability of winning. There's other mechanical strategies that I put on. You could do this one every day of the week, say at noon. Just come in, put it on every day at noon, 7 days to expiration, 65 to 70 cents in credit. You could do the put side too if you want. It doesn't have to be only the call side, but then we get back into it ain't the strategy, it's you. So that's one. Another strategy that you can do is the weekly expected move. And you can do the SPY, the SPX, the XSP, the QQQ. That's a fair game as well. You could do that one. What you want to do is build a butterfly on the strike here. Now there's three lines to choose from because even though the gray line counts, right? So you could build a butterfly on green, red, or gray, and you can do one every single day. You don't have to do it on the day of either so that you can avoid PDT. You could put Mondays on today, put Tuesdays on Monday, same thing, right? Just always go a day ahead. And that way you never have to worry about PDT. You can go farther than that out in time. The problem is theta has value. And if you go farther out in time, it might cost you more money than you're willing to risk. What you spend is your risk. So if we build one here, that's $10. I can't lose more than $10. But we don't want it here, right? We want it on that line. The XSP for next week on the call side is right at $700. Now it's at $700.80, and I don't have an 80-cent option that I can trade. I'm going to have to round up to 701 or round down to 700. With the volatility the way things are, I'd probably want to round up to 701, but let's look at the options and see if we can get anything of note out of them. If you look, here's the 700 and the 701. Look what's right below us. I tell you, I really like that 702. If I was doing a butterfly, that 702 would stand out. I would much rather do it right there. So let's just build a 702 butterfly. And there is some problems. I can see it already. The lack of liquidity, right? Look at all these bag holders. There's nothing here. We wouldn't get a fill. We'd have a really hard time finding Phil Collins in this. Phil what? Yeah, you're not that young. The 700 looks like you could probably get a fill there if you work the order a little bit. So we'd probably have to go there. It's 1 penny. Oh, the risk. Oh man, $1. Break the bank. This is why Robinhood is around, right? That's a perfect reason why Robinhood is around. The only problem with Robinhood is they'll try to close your trade on Monday before it expires. So, watch out at like 1:30, quarter to 2. Yeah, they're going to want to close that sucker. So that's the only thing that sucks about Robinhood. But I mean, there you go. $1 risk and commissions. So, $2. You could put one of these on every single day, the day before it expires. You can also just go out to Friday. There's next Friday's expiration. There's the 7 strike, 700. It's $3. That's it. Max loss, $3. The thing is, it's only on Friday and it has to go to the upside. What if it closes on the downside? Well, that's going to suck. I ran these for an entire year in the year of COVID, but I didn't know it was going to be COVID when I put the strategy together. I built it in November and December, and on that January, I went live, and then COVID hit in February, and it was just it is what it is. But I ran it the whole year anyways. Hey, when it does that. This week closed on Thursday and on Friday on the line. That Friday, pretty close. That one also close. So, you know what I mean? Like it happens frequently enough that you can get some payout. And that was only Fridays that I was circling. If you do it every day of the week, remember you needed a lot of occurrences. Well, there's 52 trading weeks, 252 trading days in a year. That's a lot of occurrences. It's 200, just round 250 trades a year. If you're only going to do the call side, you could choose to do both sides, put on a put and put on a call. You're risking a penny, a dollar. Look at how often we close on one of those lines. Right there, right there. It happens, right? There's another one that didn't close on it. That one did. That one. So another mechanical trading strategy. Every system has a downside. This downside is you will lose frequently. It's only a dollar, and your winners will cover your losses. That is not a problem. You will be profitable at the end of the year if you did it every single day. That's not a problem. It loses a lot, like frequently, and you got to have such a very strong constitution to come in and just take a loss again and again and again and again and again. It sucks. I'm telling you, I did it for a whole year and it sucks. But it is profitable. You will be profitable at the end of the year. It just sucks losing over and over and over and over and over again. But the winners, when you do hit, oh, that feels so good. And they're big. You hit a bullseye on a butterfly, it feels pretty darn good. I was talking to a Goldman Sachs analyst who said he tried to trade butterflies for 20 years and he never hit a bullseye in his entire 20 years. Never hit a bullseye in his 20 years. I told him, man, you should have come join the Bullish Bears because I hit more than 20 the year that I was talking to him. It's like I had hit one for every year he tried. Poor guy. He should totally have joined the Bullish Bears. So whatever he was doing, it was a bad system. It was him. So that's another strategy. It's very mechanical. You can just do it all the time. You don't need any sort of technical analysis or anything like that. And you could skip big days or sideways days. If today's supposed to be a sideways day, then you wouldn't aim for the high. Maybe you would aim for the center point, right? The Friday, the gray line. But even today, this scenario, we would have just skipped it because if it's supposed to be a sideways day, which we knew this morning before the open, it was supposed to be sideways, then we wouldn't put it on, right? Because we're not supposed to go anywhere. Why would I waste my money and put a butterfly on that needs us to go somewhere on a day when we're not supposed to go anywhere? So you could put some discretion into it. And again, no technical analysis required. All you got to do is put it on. I got another mechanical strategy that uses the weekly expected move. This is an early week thing. If on Monday or Tuesday we hit the edge of the expected move, go the other way. Generally, I mean that with a short spread, but you could just buy a call or buy a put. I'm not a fan of buying the option. I'd rather just take the short side. The reason for that is when we fall on a Monday or a Tuesday down into the weekly expected move, it pretty much says we've moved as far as we should move in that direction. But nowhere in that sentence does it say it owes us a move back in the other direction. It just says, hey, you're likely done falling now in this case. If we had gone up, it says, yeah, you're likely done going up now. But that doesn't mean we have to go down, right? Just that we won't continue to go in the same direction, which is why I like to do the verticals or the short verticals. It's a good strategy. I don't like doing it late in the week. So if we got to the edge on a Wednesday afternoon, Thursday afternoon, I don't like to do it that. Monday or Tuesday, great. Wednesday or Thursday, not so great. Here is this week. On Monday, we opened and we ran and we closed outside the box of the expected move. That's the weekly EM low right there. If you had put the spread on before the day ended, which is the way my strategy is built, put it on before the day ends, then you'd have been good. Look at that. It went back in the other direction. Maybe that was just luck, right? Because here's one. If we had put it on that Tuesday afternoon, right there, Wednesday and Thursday was fine, but by Friday, it would have run us over, right? So if we didn't have a 1 or 2 day trade and instead we had Friday's expiration for that trade, we would have lost. But if you'd have just got it for 2 days, you'd have been good. That would work. We got to the edge here on a Tuesday and got run right the hell over. So that wouldn't have worked. When it comes to these mechanical trades, by the way, one of the things that I've learned, I didn't add it to the rules because I didn't know it when I was writing these rules. Short weeks really break the system. So if you're running probability based trades, be careful of short weeks. They break your probabilities pretty hard. I learned that by trading a bunch of mechanicals for an entire year during that COVID year that I was mentioning. I didn't just do butterflies that year. I did a lot of mechanicals. It was kind of neat because for the whole year, most of my trades were mechanicals. I didn't have much time for non discretionary or discretionary trades. So if you skip doing this on short weeks, this reversal off the edges, then you'll get less occurrences, but you'll also have less losses, I would bet, because they just won't. They won't be. It won't happen as often. So the whole idea is go the other direction if we get to the edge on a Monday or a Tuesday. Preferably with a vertical, short vertical. All right, now this last one, I think we got time. You guys we got it's a little complicated, but I think you can handle it. You got time for one more? Because I know it's the weekend. I don't want to keep everybody, but if you got time for one more, this one there is a video on the Bullish Bears next level library. So for this next one, you could just catch the video, really. But I'm willing to go through it if you guys got the time. All right, this last one's called a Marcus trade. And poor little Marcus, he ain't with us anymore. He's gone. We had to put him down. but it was named after my dog. And the idea is we used to run a weekly iron condor. It's a fantastic trade. Every week we built iron condors on these ranges. It worked fantastic. And we all knew, like every Friday in the live stream, that's what we were doing. We were building these verticals. It was these iron condors. Awesome. Had spreadsheets tracking our record, and we would all talk about where we were closing them. Just fantastic. The problem is it doesn't work anymore. The ranges are so wide now that we can't get enough credit, and we're taking on way too much risk for the amount of probability that we have. So the entire system is broke, and we just can't use it anymore. So I wanted to replace this with something else that would still do the same job as the Iron Condor. If you're kind of new to trading, you might be a little unfamiliar with the Iron Condor. It's two verticals, one on the call side, one on the put side, and it creates a box around price. And the only thing that price needs to do is just stay inside the box. And then time needs to go by. So if you put on an iron condor, for Friday, a week away, on Monday, you can't decide that you want to close it in profit because, well, you wouldn't have any profit yet, right? So it is a time based trade. So here's the XSP, and we can see next week's range. So we'll go into the options chain, and we'll just quickly build out this iron condor for next week. We got Friday's expiration, 682 on the downside and 700 on the upside. Now we want 700 to be the middle of the spread. So I'm going to make my spread $1 wide, or $2 wide, so that it goes across the 700. We don't have to do that, right? I'm just trying to kind of prove a point while I'm at it. So $2 wide, I've got 57 cents. We'll go to the other side. We got to make them equal distant. So I'll do $2 on this side, and it's at 682. Well, I need 82 to be in the middle, so I'm going to use 83 and 81. All right, so now I'm $2 on this side, $2 on that side. I've got $1 in credit for a $2 wide iron condor. That's not bad, right? That's almost like 50%. So 1 to 1. I'm honestly surprised I got that much credit in this thing. But whatever. We'll we'll take it, run with it. So this is the vertical, right? And since the rules say that price should close within this range 70% of the time, we know that this iron condor has a 70% win rate. We're going to set the break evens on that, and then we're going to set them out to the chart and see how far away we are from where we need to be. Look at that. Not bad. We nailed the bottom side perfectly. We could move the line up on the call side a little bit. We're a little short. It needs to be closer to 701 actually, right? So let's adjust that and move that up just to see what we would get. We'll make this 702, and we'll make this 700. We'll unlock it. We lost a little bit of credit there, right? Not a whole lot of credit, but a little bit. Let's see what that does to our break even. All right. So go back into the Analyze tab here. Look at that. Our white line covers up both of those lines. So our iron condors break even is the edge of the weekly expected move. This trade will win 70% of the time. And honestly, we got enough credit that we could actually run the damn thing. It's been a long time since I was able to say that. Typically, when we build these, we would be getting like 42 cents in a $2 wide trade, and it's just not enough money, right? This is actually relatively decent money. I just surprised. So there you go. That would be the weekly iron condor, and you could do that every single week. As long as you're getting enough credit for the risk that you're taking, knowing that it's a 70% probability trade, they look at the amount of credit and say, okay, if I did win this 70% of the time, right? We come back to this. We got what 80, let's call it 85 cents. We'll handicap the trade a little bit. 85 cents on the win, and the loss is $1.15. Oh, maybe that's not enough, huh? Oh, I gotta adjust the numbers still. That would be 850 when we're right, and it would be no, not 850. I did that math wrong. This is a 70% win rate trade. So we would win 700 of these, and we would lose 300 of these. Look at those numbers. Now, if we close the losers early, we could cut that 350 down by probably at least a third, right? But we could get it to like 250 for the loss on the year. And on the profit side, if we don't close at max profit and instead we closed early, then we could cut that number down to like 400, 450, right? Still, it's a winning system. So you can check to make sure that it is. But what if it isn't? Which is what I was going to show you. There's a trade called a double diagonal. So we're going to uncheck this. We're going to keep it, but we're going to uncheck that because I want to study it more. If my system is back, I'm going to be so excited. I haven't been able to trade it since COVID. COVID killed the iron condor. So there's a what we call a double diagonal. And we can just tell it that we want to do it this way. We're going to do a double diagonal. Maybe a double calendar, but I like the diagonal. We'll try that first. So it built it wrong. We always have to go in and fix it. But what did it build? I was on 700 here. So I'm selling the 700 for January 30, but I bought the 701 for the February 2nd. Now I can adjust that and make it also a 700 for February 2nd. But we'll leave it at 701 for now. Just, leave that side alone. It's the put side we have to fix because it doesn't know what puts I wanted. It knew the calls because that's where I started it, but it was completely off on the put side. So we got to go in and manually fix the puts. That's 682. So we just come down here and move the put side to 682. Well, actually, we'll go 683 because we want to be above I think we might have to adjust that. And then the long put, we want 682. All right, so now we've moved it considerably. Let's see what that looks like. Bat ears. Why this? Right? Well, look at my break evens. And we still might need to adjust, but the downside is 676 and the upside is 704. I picked strikes in the same spot as the other one, kind of in the same area, right? But it pushed our break even way wider than we need it to be, which is awesome. That means we can tighten up our strikes and get more money for the trade because this is fine. It's $22. But wouldn't it be better if we could get a little bit more money? Plus, with those puts, I think we should probably readjust that a little bit. Probably. Let's see if we turned this into a 2 and left that as a 2. What's the cost there? 43, and it dipped it down a little. Brought our break even in. Let's push this to a 3. Brought our break even in. So, okay, we'll put it back at 2. And we'll put this back at a 3. Leaves it back out there. And then if we move it to a 1, yeah, no, I'll leave it at 3. All right. So this trade would cost us 21 debit. Max loss? I wish. That would be awesome, right? Right. Wouldn't that be awesome if that was your max loss? Unfortunately, it's not. We can see the max loss is over here on the left in the bottom. If I stop there, it's $100, and on this side, it's 142. So that is actually the max loss, not this 24 debit. But you pay 24 debit to get in, and your short option is in the. That's what's wrong with these puts. The Yeah, the short option is in the back. It kept it right. I was about to say it screwed up my trade, but it didn't. February 2 is where the long options are, and in the front end, January 30th is where the short options are. So we've got a long call and a long put held in the front end that are going to expire, and then we got the other side for Monday, and it makes the trade really wide. So we could tighten it up, and we could get these peaks taller. But look how much room SPY has. SPY, SPX, whatever we choose. The break evens between these levels are really big, much farther than the expected range model. So the expected range was $11, and our range in here is much bigger than $11. It's like $30, pretty close. What is that? 674. Oh, 676, 85, 704, 83. That's $28 is how wide our trade is. And it only needs to be $10 wide. That's awesome, right? That gives the trade so much room to move around. And if it closes anywhere inside this thing, we make money. We don't have to wait till expiration either. As it's in here moving around, we just got to keep our eye on these short contracts that we traded. And as they get cheap enough, we decide how cheap we want them to be. We go ahead and close them out, and we still have the long options for that following Monday that we could also close, or we could just keep them. This is called the Marcus trade. And the reason I made it was so that we could expand on how wide our break even is. So these break evens from that iron condor, I'm going to mark them so that we don't lose them. And then I'm going to send these other lines out. Much wider. Look at that. Well, let's just use the big screen. Why not, right? Look at that. The white lines is what we need price to stay in. This is how far we're projected to move in the next week. And this is how much room we're giving the market for next week. That's the double diagonal. How awesome is that, right? Plus, it's a Friday close with a Monday kicker. So as we get through next week into Wednesday, FOMC, and into Thursday, and we finally close out those short legs, which I would argue you watch them through the week. Say we dip down hard on Monday, down hard. Well, your puts are going to get really expensive. So you can't do anything with the short puts, leave them alone. But your calls would get crushed, right? That's awesome. You have a short call. You would close that on Monday or Tuesday, get it right out of the way. That's eliminating that side. Then FOMC comes, we rip to the upside. Now your puts are getting crushed. Perfect. You close that out. So before Wednesday FOMC is even done, you're already out of both short legs. And all you got left is a long call and a long put, which you could choose to have already closed because you can close the longs out with the shorts, or you could leave them on, depending on how bullish we were into the close on that FOMC day. You might decide to go ahead and close out that long put and you keep it, the long call, just to see how much further you can go. It is preferred to close both out at the same time, but you don't have to, is the point. Especially if it's something overwhelmingly bullish or overwhelmingly bearish, that you could just keep one leg on. So yeah, that's the Marcus trade. It was my solution for the overly wide weekly expected move models because the iron condors were just giving so little credit that we had to quit doing them. This is this week's range. And if I take it back to before COVID and look at the ranges that we had way back, way back then, you'll be amazed at the difference between them. We're just going to go to a daily, knock it back, 10 years. And now I got to find my box again. I'll just make another one. Not a biggie. So this is our range for the week. And I'm going to just make it wide so I can find the darn thing when I zoom out. That's our range. And it looks really big, but how long I made it doesn't matter, right? Only how wide I made it. So there's COVID. Look at the range on the week. And I'm not being picky. I'm just grabbing one random week. You can see from week to week, it wasn't that much different, right? So that was the week's range on average before COVID came along. And this is our week average right now. Just to kind of compare the difference between the two, look how wide that one is and how wide that one is. Significant difference, right? That's why the iron condors don't work, because this is our weekly expected move after COVID, and this was our weekly expected move before COVID. One is 5 points wide, one is 20 points wide. Yeah, I miss those days. Those were awesome. So hopefully, you guys got something out of today on the idea that there is ways to trade in the current environment. It doesn't matter, FOMC, CPI, PPI, earnings. It doesn't matter. There are ways to trade. And just because you're new to trading doesn't mean that you're handicapped, because these systems will work no matter your level of trading experience, as long as you stick to the math, right? Yeah, next week's FOMC week. And the anticipation is that it's also going to be a sideways week, Monday and Tuesday, as we hurry up and wait. That's what I call it. That's my little tagline. Hurry up and wait into FOMC. So we would want to play range bound strategies into FOMC. But these pink lines our previous FOMCs. And when you have those lines while you also have the weekly expected move, you can see, hey, how did the earnings week go on a week where we had FOMC? And I can go back in the past and I can put those two pieces together and I can look at it and be like, oh, okay, well, on this Monday and Tuesday, we really didn't do much. And then we had FOMC and we still really didn't do much. And we went into the end of the week and we just didn't, we didn't do anything. But there's other FOMC weeks where we started at the we ended that Monday at the end of the weekly expected move right there on a Monday. That was a FOMC week, and we gapped and ran all the way to the edge of the weekly expected move by the end of the first day. So, we can't say, oh, well, it's FOMC, it's just going to be sideways, because that's not always true. But it is our base case when the range is narrow and it's an FOMC week, because that means that's what the market priced in. They might run their mouth and say, oh, yeah, we're bullish. Oh, yeah, we're bearish. But we don't care what they say. We just care what they trade. And if they traded sideways, then we want to know it. This morning, it was more sideways than it is now. It's not as sideways. We're also not looking at the same product. So let's look at the ES, because that's what we were looking at this morning. And look at how wide the range is. The projection for next week is this. And granted, we are comparing a 5-day week to a 4-day week. And look at that. It's the same as it was this morning. So next week has some volatility priced into it, but not as much as you would think. And that's because we just compared a 5-day to a 4-day, and they have the same movement measurement. Next week is projected to be a hurry up and wait week. Doesn't mean that's what we're going to get, but it's what the market priced in. It's what traders traded. Yeah, I mean, there's nothing wrong with hoping for some good price, but I didn't have a lot of bullish expectations coming into this week. Um, One, it was a short week, but two, we have all this drama. The market has so many things that it's waiting on. I just had a hard time seeing where the bullishness would come from in the face of all that risk. There's something about earnings that I'm slowly getting better at. And the idea is that when earnings kick off, and the banks are the trigger for that, right? It always starts with banks. When earnings kicks off, the market really does a sideways thing until at least after the Mag 7 is done. Now, of course, that's not a always thing, but it's a more often than not thing. And it's growing on me more and more. I didn't used to be so adamant about it as I am now, but I'm way more comfortable on believing that we're going to just chop when I hear that banks are about to kick off earnings season. And I think about that for a moment. I'm like, oh, shoot, here we go again. Another, 6 weeks of sideways, because we're going to go through banks and then Mag 7. And then finally, the market's going to start to move. And that's kind of my bias right now. We're getting through banks, but we're not yet into the Mag 7. And I'm not really expecting the market to do a whole lot until we get done with Mag 7. It's kind of cheeky, but I mean, it's it's right more than it's wrong, unfortunately. Kind of just yanks the rug out from underneath you when you think about it. You're like, well, shoot, why would I even bother to buy, Google or Amazon or Apple or any of them until after earnings if they're just going to go sideways anyways? Well, what we've been doing for decades is getting broken. And there are so many global recognized award winning analysts right now who are throwing up their hands saying, I have no idea what's going to happen next. And that scares the hell out of me because they've been doing it for 40 years. And if they don't know, what are we supposed to do? Right? Like, I'm good, but it's hard to compete with a 40-year veteran who's been doing this when they saw the old system built and used for a decade and now getting it tore apart and they still are sitting there saying, I have no idea what the hell's going to happen. You know what I mean? Like, well, I don't know. It's a huge risk. We all are recognizing that, but we have no idea what's going to happen. And if something snaps and breaks, it's gonna be like 1987 flash crash Black Friday kind of thing, or Black Monday, whatever it was. It's gonna be really bad if it happens. And I mean, nobody wants to see that happen, but it's certainly possible. How did that thing go that we were talking about? Nice. That's a good start. Yeah. Yeah, and the rest can be made up later. That's a small amount. I always like it when he drops in. He's always got something to share. So that was, hopefully this got you guys somewhere. It's not a one day thing. You can't just stack it all up and, go running out into the wild after one day of this. But hopefully I got you thinking about probability based trading because, a lot of people talk about the success rate of trading a breakout or the success rate of reversals or, how do you put probabilities on that stuff? What if it was a 1 minute chart versus a 5 minute chart or versus a 15 minute and a breakout in Apple versus XP or the ES or there's just no good way to do those kind of probabilities, but options are completely different. Now Intel, I had Intel. I closed my Intel out yesterday. I'll show you guys my Intel trade. Actually, I think I still have a picture. So back in September, I got into Intel with a call. I bought a 40 strike call and it was going to expire January 16. And I was in such a good position that I wanted the stock, but I didn't want to buy it at that stock price. All right. So here's where I got in with the call right here. It was the 40 strike. So I was aiming for this January 16. And up here, I'm in the money, right? Because I'm above that 40. And I didn't close the call. I left the call on into expiration. Got assigned, took my shares at $40 a share. And then yesterday, I closed those shares above 54. So I made $14 on this, and I made, I don't remember exactly how much, but like 400 or 600 on the long call, right? So there I am with 100 shares. I'm looking at things yesterday, and I was talking to somebody else who was in Intel, and they're like, "Dude, just sell some calls on your shares, like why not? Get some good credit, sell it like 52 or 53, 54, whatever, because you're going to get a good chunk of credit." And I would have too. I think I was looking at 4.5, $5 in credit. Sounds great. My concern was, how much would I lose if the stock just face planted? And they're like, "Oh no, it's not going to do that. It's going to have a good earnings, blah, blah, blah." I kept looking at those options. I didn't see anything that I liked. And I sold my stock yesterday, and it did this. Now, is it done? I don't think it's done. It's got a sugar daddy, right? The government is invested in Intel. They're not going to crash and burn, but it could certainly stay weak for a while. And that was my concern, right? So I was looking back. I thought I took a picture. Maybe that's it right there. Yeah, there it is. So here's my trade. I'm kind of zoom in here a little bit. September 29th, I bought, one January 16th call, 2026, $3.17. And you can see buy to open 100 shares, exercise, option removed. And then I sold my stock at 54.20. So took the shares at 40, sold them at 54.20 after taking the calls from assignment or from exercise, because I basically exercised my right as a call buyer and took those shares at $40 a share, right? So why did I do that? Because I thought it was going to be sideways for a while, or worse, I thought it was going to fall back down here. Yeah, we could totally do that. I mean, if you look at this, it was this big gap up with the whole government thing, because the government decided they were going to invest in Intel, and then I don't know, like Nvidia, Google, it got all these investors, and they wanted Intel to provide something to the whole AI trade sphere, and the government's got their back. Well, that was back in September, and I thought, well, that'd be a good, long haul trade. So it wasn't necessarily something that I saw in the chart. It was just the backdrop. I wish it was some kind of pattern or something that I could point to and say, yeah, when you see this pattern, go long. But it wasn't. It was just all of that backdrop and that bullishness. And then it had that strong gap up, and then it pulled back a little bit. As I've mentioned before, I like to buy my calls on down days, on red days, right? I don't want to buy them when everybody else is buying them. I want to buy them when somebody's trying to sell them. So if there was anything to really share on why that, well, I bought it on the red day, and I was looking for upside because it was the whole situation with the government and Intel and Nvidia, and just everybody was like, support Intel. If you can't lose, then you might as well win. Intel was put out there as a company that can't lose because it's got government backing, it's got a sugar daddy, it's got all these AI investors. Sounds good to me. Sign me up. So I ran it for an earnings, and then I got the hell out before the next earnings. But look at the last earnings, by the way. It probably has a little bit of a tell for this earnings. On that last earnings, it pulled back, and then it did struggle for a while, but it finally got going again. I would not be surprised at all if it did the same thing this time. So if we was to measure this, yeah, about that much, and we set it up here, I swear you can't make that up even if you wanted to. probably about as far as we go to the downside. Don't get me wrong, we could wick around here a little bit more, right? But I think it should probably hold above 44 and build a bit of a base, and then it's going to make a run towards this high. Now, the key is what's it going to do with this high? If it comes up short and falls, that's going to be kind of scary. We might end up setting some lower levels. But if it makes an equal high or a higher high, it's game on. We're going to continue to the upside. So this was really just more of a trade of bias than anything else. Between the headlines and the background and the investors and just all of that. And then, they gave me a red day and I took it. Awesome. You can do the other side too. If you're trying to gauge the next run, if we stay bullish, that's next earnings season, 65. Isn't it though? I love it. Yeah. When I first learned that, I thought, no way that works. But damn if it don't work again and again and again and again. It just keeps working. All right, everybody. I hope you have a good weekend. Please be careful. It's supposed to be really cold out there. If you're traveling, make sure you got backup. Let people know where you're going, what direction, what roads you're taking. Just be careful.